What is crypto arbitrage trading? Aren't we all into cryptocurrencies for the money? And every time we dig into it, we see 1,000 different ways to make money from it. However, very few ways promise profits as much as crypto arbitrage trading does to the average crypto investor. So, what is crypto trading arbitrage, and how can you make money from it? In this video, you will learn everything you need to know about arbitrage in the context of cryptocurrencies, how it works, and the best platforms to practice it. Arbitrage explained, how IT works. Arbitrage is one of the many exclusive opportunities that a few people have harnessed in the world of financial trading. Think of arbitrage as a treasure hunt. There are 3 different marketplaces where you can get the treasures you need.
For this video, let us call these markets A, B, and C. These markets are not just different in names and locations, but each of them has its own unique way of valuing the same kind of treasure, which may be a piece of ruby or a golden coin.
So, imagine you wake up one morning and go to market A to buy the golden coin for $100 and go to market B to find that it is sold for $110 while market C sells it for a whopping $120. This suddenly presents a golden opportunity for you as the secret world of price disparities across different markets suddenly opens up. What arbitrage does is the process in which you can buy the golden coin at $100 in market A and sell it in market B or C at $110 and $120, respectively. You can buy it in market B and play on the slight price difference to make $10 per gold coin. The best part is that you can buy as many golden coins as you can afford in market A to sell at either B or C without restrictions as long as the price disparities remain. You could buy 10 gold coins at $1,000 to get a $200 profit in C or $100 in B. It depends on your choice of profit margin or as the market opens up to you. This is the simple description of everything arbitrage is all about. Arbitrage as a principle is applicable across different financial markets. All you have to do is buy low in a market and sell high in another. You could buy gold at a $5 price difference from one broker and sell to another market at a higher price. An arbitrage trader can turn a $100 investment into $120 in such a short period. It seems like magic, but arbitrage is much better. It is real. When applied specifically to cryptocurrencies, arbitrage is the art of looking across different crypto markets and exchanges for price differences and capitalizing on them. Let us say, BTC is trading at $27,500 on Binance, but it sells at $27,400 on OKX. As someone with an eye for arbitrage, it is wise to buy at OKX's price and sell on Binance to gain the $100 profit margin. It is as simple as buying an apple at $1 on the local farm market and selling it for $2 at a convenience store. One thing about market arbitrage is that these price disparities do not last forever. In fact, the opportunity presented may barely exceed 30 minutes. For cryptocurrencies, it could be less than that. That's why crypto arbitrage hunters are considered some of the best traders in the crypto industry. They have mastered the art of looking for the right cryptocurrency to arbitrage and acting fast before the prices can equalize. The opportunities for arbitrage are everywhere, all it takes is a sharp eye and a quick mind. Methods of crypto arbitrage. Now, let us look at the types or methods of arbitrage. There are 3 major ways to do crypto arbitrage that you can explore. These methods can be generally applied to arbitrage, but we will look at them in the context of cryptocurrencies. The first is the triangular method. How does it work? You are into triangular crypto arbitrage when you consider the price of 3 different cryptocurrencies and look to exploit the price differences you can take advantage of when you convert from one type of coin to another. This means that instead of the usual 2-step trade of buying a coin in one market at a low price and selling in another at a higher price, you now have 3 trades.
For example, suppose you have 3 cryptocurrencies, A, B, and C. In that case, the process will involve converting cryptocurrency A into B, B to C, and then turning it back into the original cryptocurrency. In the process of these conversions, you take advantage of slight differences in the exchange rates of each cryptocurrency to generate profit. A real-life scenario will look something like this. Imagine a crypto trade. Mike observes that 1 Bitcoin is tradable for 30 Ethereum, and 1 Ethereum can buy 3 Litecoin while you can exchange 1 Litecoin or LTC for 0.1 Bitcoin. So, the triangular method of arbitrage will see the trade sequence go in the following ways. In the first step 1, Mike converts 2 BTC to 60 ETH at 30 Ethereum per Bitcoin. In the second step, he converts 60 Ethereum to 180 Litecoin at 3 LTC per ETH. In the final stage, he converts the 180 LTC back to BTC at 0.1 BTC per LTC.
which will eventually give Mike a new amount of Bitcoin that is higher than the amount he originally started out with, thus making a profit due to the price discrepancies between the cryptocurrency pairings. One of the reasons this works for cryptocurrencies is because of the market volatility and the fact that the price of one cryptocurrency compared to another differs relative to other cryptocurrencies or its value against the dollar. The second type of crypto arbitrage is the spatial arbitrage. It involves leveraging the price differences of the same cryptocurrency on different crypto exchanges. Due to supply and demand, the price of BTC may differ on Binance and on another platform like KuCoin. Other factors may include geographical factors and trading volume. So, Sarah, a crypto trader, may buy Bitcoin on exchange A at $40,000 and sell on exchange B at $40,500, making a profit of $500. The third is temporal arbitrage. This is the time-based method of arbitrage. It is when a trader exploits the price variations of the same cryptocurrency over a period. Some traders have done good work of studying and discovering opportunities when a coin's price is likely to change significantly. They may buy when the price is about to rise, and when it rises, they sell when it is about to fall and generate profit from the price movements. This is technically similar to what we know as spot trading and can be carried out on a single exchange. A typical example is if a crypto trader looks for news about a major happening due to a crypto event, and it is likely to increase the price of a cryptocurrency like Ethereum. If ETH is trading at $1,850 and he buys like 10 Ethereum, when the price increases to, let's say, $2,000, he has gained at least $150 per Ethereum and ends up with a profit of about $1,500. Of course, the downside to this kind of arbitrage is that it is not guaranteed, and different factors like lack of buyer interest can prevent the expected surge from happening as expected. Crypto arbitrage has inhibiting factors such as high transaction costs, market volatility, and inadequate speed. Low capital can ruin any chance of profit from arbitrage for any trader. It is up to you to assess each opportunity as it comes and choose the right tools and resources to leverage this type of trading. Factors that influence the success of crypto arbitrage trading. 3 things can affect your arbitrage opportunities: your exchange choice, timing and speed, and the risk and challenges involved. When choosing a crypto exchange, you must consider liquidity, the amount of trade volume the exchange has. This guarantees there won't be a risk of large price swings, and you can execute trades much more easily. Another thing is the trading fees on the exchange. Sometimes, gas fees can wipe out the meager profits you can get on an arbitrage trade. Therefore, factor out each exchange's deposit, withdrawal and trading fees before activating a trade so they don't swallow up your profits. Suppose an exchange mandates you to conduct KYC before using the platform. In that case, you may be unable to use it for arbitrage, considering you have to execute trades as quickly as possible. In another instance, you may not be able to use some exchanges due to geo-restrictions, even though they offer the best price discrepancies. Also, not all exchanges support the cryptocurrencies you intend to trade. The best crypto exchanges you can try out are the popular ones, such as Binance, Kraken, Huobi, Coinbase, etc., due to their large liquidity and bountiful cryptocurrencies. Timing and speed are other things you must conquer to enjoy crypto arbitrage. Crypto prices are rapidly changing, and the slightest delay in making a trade can make you lose or gain lesser profits than you would if you were much faster. Many other traders are also into arbitrage, and you need to execute faster as a limited window of opportunity to do arbitrage. The best way to overcome this timing challenge is to use automated trading bots or buy API access into an exchange by connecting your trading software or setting real-time price alerts so you can react as fast as you can. However, you still have to deal with the risk of market volatility and slippage where the actual price of a trade is not the same as the expected price at the time of executing a trade. What is the best strategy for trading arbitrage? You can do it manually, as I have explained in most of this video, or automated. The benefit of manual trading is controlling what to trade and when to trade. It also helps you to gain trading experience and improve your skills. It is also cheap, and you don't need to rent or buy trading bots. However, it is much slower than the automated method, and you can make awful decisions that lead to losses. Automated trading with bots is much faster, down to milliseconds with deadly accuracy, and you can enter trades faster than most manual traders can ever do. It is consistent and reduces the margin of error in trading, providing small and gradual profit over time. A bot can also conduct more than one arbitrage trade simultaneously. You can easily go to sleep or go on vacation in Ibiza while your trading bot does all the heavy lifting. I will say that this system's con is the high cost of renting or buying access to a trading bot. These are some of the best insights you will ever find on crypto arbitrage trading. For a full trading experience, I recommend that you familiarize yourself with tools like TradingView, mobile apps like CoinMarketCap and CoinGecko. Arbitrage scanner tools like CryptoCompare are especially geared to identify arbitrage opportunities on any crypto. Some of these things may come at a cost. Still, you can also find key info in legit Telegram and Discord groups when you join crypto trading communities and gain access to real-time market info and arbitrage opportunities. I hope you have learned something useful in crypto arbitrage trading and are ready to begin to apply them. Let me know if you have any question or comments, leave them below. Please give a thumbs up and like this video, we would love to hear from you. Thanks for watching.